Get recording started.
All right, good morning, everybody. This is the Wellers 2021 budget review for private clients. I'm going to take you through the changes in the budget. Please feel free to ask any questions as we go along. I'll start with the income tax personal allowance. This rises to 12,570 from the 6th of April 2021 and then remains at this level up to and including the 5th of April 2026. The personal allowance, as always, is reduced by £1 for every £2 of income over £100,000. The higher rate threshold rises to £50,200 and then remains at this level up to and including the 5th of April 2026. The higher rate for savings and dividend income also applies these rates. For 2021, the income tax bands are therefore from the personal allowance of 12,570 up to the higher rate threshold of 50,270. This band will be taxed at 20%. The higher rate starts at 50,271 up to 150,000, and that's at 40%. The additional rate is 45% for anything above 150,000. This means that you earn an extra £70 without paying any income tax. The starting rate for savings income is 0% up to £5,000, so the same as last year. These rates have not changed since last year for dividends. They apply to dividend income received above the 2,000 tax-free dividend allowance. And for dividends received within your basic rate band, it's 7.5%. Within your higher rate band, 32.5%. And within your additional band, 38.1%. I will be sending everybody slides, so you don't need to take any notes. The saving rates are obviously that you've got your 0% for the first 5,000, then you've got 20% within your basic rate, 40% within your higher rate band, and 45% within your additional rate band. Your allowances for those where one or both of the partners, civil partners or spouses were born before the 6th of April 1935, you receive an allowance of £9,125. This is an allowance for the higher rate taxpayer if you were married within, I think it was from 2005 onwards, but prior to that, it's always paid to the husband. It's always attributed to the husband's sort of tax band. There is an income limit for the person who receives the married person's allowance, and the income currently for 21-22 is 30,400. If one or other of you were not born by the 6th of April 1935, then instead you can receive a married civil partner's allowance of £3,530. I'm going to explain these in a little more detail in the next slide. The blind person's allowance is 2,520. The rent-a-room relief is 7,500, which means you can in effect have a lodger and not pay tax on that income, but they do have to have access. They cannot have self-contained accommodation. They would have to share the lounge, etc., and live with your family. The savings allowance works out at £1,000, so that's in effect not paying tax on your first £5,000 of savings income. The trading income allowance and property income allowance are allowances that you can claim as opposed to be putting to strict proof on your expenditure for those incomes. So if you have a rental property, if you feel that your expenses are under £1,000 a year, then by claiming this trading or property income allowance instead of claiming your expenses, you don't have to be put to strict proof. And obviously trading income would be sort of really for hobby trades where you may earn income, and obviously it costs the HMRC more money to process your tax return application for that income, when normally in effect you'd probably be making a loss. So what is married couples allowance? The married couples allowance is a more generous version of the marriage allowance. It's for couples who are married or in a civil partnership, but they're only eligible if one or both of them were born before the 6th of April 1935. Marriage allowance is a type of tax relief. A UK taxpayer can transfer 1,250 of their personal allowance over to their partner. Whilst the personal allowance is deducted from your total taxable income at the end of the year, the marriage allowance is credited as a reduction on your tax bill. For those taking advantage, the recipient's tax code will normally change to M, and the sender's tax code will usually change to N. You can backdate marriage tax allowance claims by up to 4 years, but you must be eligible for all of those years. Earnings should all be within the specific tax thresholds of any past years. Employed class 1 NIC. If you're earning less than £9,500, the rate is 0. Between that and the higher rate band of 50,270, you pay 12%, and if you're earning more than 50,270 on that portion, you would pay 2% NIC. Class 3 voluntary contributions, where perhaps you're unemployed or exempt and you want to receive your state pension, you can pay an amount of 15.40p per week to top up those payments. There's not been very much since tax threshold front. Inheritance tax nil rate band and residence nil rate bands have been at the same amount up until April 2026. As you know, the nil rate band for a UK domiciled individual is £325,000. The residence nil rate band, if the deceased owns a home or has owned a home, is £175,000. Same conditions apply. It's got to be gifted to the class of beneficiaries, children, stepchildren, etc. And the residence nil rate band taper continues. So if your property is worth more than, or your estate is worth more than 2 million, then for every £2 it's decreased by £1, reducing that 175,000 eventually to 0. The first to die, if they leave everything to their spouse, then you can, because there's spouse exemption on that first death, the nil rate band and the residence nil rate band will not have been utilised, and so they can be transferred to the surviving spouse, provided it's actually going to, in respect to the residence nil rate band, to the beneficiaries that would have been entitled had the first spouse transferred it directly to them. Now, that's dealing with UK domiciled individuals. If you're non-domiciled, as in you were born abroad and you haven't chosen the UK as your permanent residence, so you haven't had the intention of changing your domicile to the UK, then you still receive the standard nil rate band of £325,000 against your UK assets. If you're non-domiciled but your main residence is in the UK, then you can still qualify for the residence nil rate band. Where a married couple are both non-domiciled and they leave their assets to their UK assets, because obviously this is just the UK estate, to each other, then they get full spouse relief and they get the transferable nil rate band and transferable residence nil rate band if applicable. If the tricky situation is where the first to die is UK domiciled, but their spouse that they leave everything to is non-domiciled. The spouse relief is limited to £325,000. They also have their own nil rate band, though, still of £325,000. So that in effect means that £650,000 of UK assets gifted from one spouse, from the UK domiciled spouse to the non-UK domiciled spouse, 650 can be transferred tax-free. Alternatively, there's another option now. The non-domiciled spouse that has survived can elect to be treated as UK domiciled within 2 years of the death of the first UK domiciled spouse, so that the first to die. But there is a condition: they must become UK resident for income tax purposes for 4 successive tax years, and that four successive tax years can begin any time after the election, but before the end of the period. Now, given that the residence and the nil rate band situation has not changed, our capital gains tax position, I'm going to come back to inheritance tax opportunities. The annual exemption has risen to 12,300 in April, but it's going to remain at that, so we're not going to get any sort of further increases there for the time being. Now, in terms of inheritance tax, obviously we therefore have to sort of rely on our traditional gifting. So if you need to get assets out of your estate to save inheritance tax, then you can make gifts to individuals, or you could make to for example, a discretionary trust or a bare trust for another party, as long as you're not a beneficiary. And you have to survive 7 years for that not to be treated as part of your estate on your death. If you obviously make gifts into a discretionary trust, say for example for grandchildren, etc., you're then in a position to be a trustee, manage those funds, but they still remain outside of your estate after 7 years for inheritance tax purposes. You can make gifts out of surplus income. Now this is, there is a specific tax form on the inheritance tax form for gifts made out of surplus income, and they want to know, the gifts have to obviously be regular. They want to know exactly what your income is, your expenditure, including holidays, etc., for the respective years, and they ask for this information on your inheritance tax form once you've passed away. So you need to carefully collate this information if you're going to take advantage of this particular relief. Other opportunities, obviously none of us know when we're going to pass, would be to transfer your assets into a life interest discretionary trust where you're married, so that you get spouse relief going into that trust on your death. That trust can then be managed by your trustees and put into a asset profile, perhaps by investing in business property assets, by making gifts out to beneficiaries in a tax efficient way. So it enables tax planning to happen after the event and to take advantage of, obviously, you, for example, if you pass, you transfer your assets to your spouse either directly or via a life interest discretionary trust where the spouse has the right to income and the right to reside and may have a right to capital as one of the discretionary beneficiaries amongst your children and other beneficiaries who also can potentially benefit from capital assets if required. It can take the form of loans to those beneficiaries if you don't want the assets to be passed to them directly. And obviously, if it's in a loan format, or for example, the trust funds are used as a deposit on a property for, say, a child, that trust can take a share in the equity and the trust fund will grow. On that child's death, it is a debt of their estate, has to be paid back to the trust, and it's not an asset, so it will therefore be taxed again. So there's multiple tax benefits by putting your assets into trust, and it also enables you or your advisors to efficiently structure your trust fund in a tax efficient way. So there are opportunities that you could actually end up not paying any inheritance tax at all if it's managed very well. And it really doesn't matter how large your estate is. So by putting it into trust, there are then planning opportunities in the future after you died to mitigate inheritance tax dramatically. But it does need advisors that are familiar with trust law and trust tax law in order to achieve that. Going on to the capital gains tax, obviously our situation is not going to improve until after April 26. So if you've got assets that are heavy with potential capital gains, if you were to dispose of them or gift them, then you could look at gifting just your annual exempt amount. This could be a proportion of a chargeable property. If you've got a rental property, you could do it in tranches over sort of 10, 15 years, gifting portions to your children. They would be entitled to the relevant proportion of rental income as well. Another possibility would be you can gift up to your nil rate band, which is £325,000, into a discretionary trust. And this would entitle you to apply for holdover relief. So the trust, it doesn't actually trigger a gain on the gift, which it would do if you gave to individuals directly. The trust inherits your base costs, so the amount that you actually paid for the asset. And so that can crystallize the gain at that point. It's then held over, so when the trust ultimately sells it, the trust will have to pay that tax. But alternatively, the trust could then appoint that chargeable property before they sold it out to multiple beneficiaries, and then each of those multiple beneficiaries would have their own annual exempt amount for their portion of the gain, thereby reducing the capital gains tax bill. Pensions, the lifetime allowance is going to be maintained at the current level of 1,073,100 until April 2026. The annual allowance remains the same at 40,000. I've got a note here. I do not normally give pension advice. I would refer you to an independent financial advisor for this information, but this is just a summary. Up to the lower of 100% of earnings or the maximum. The maximum contribution is the annual allowance, which is 40,000, plus unutilized allowances from the 3 previous tax years where you've not paid your full amount of potential pension contributions. And up to 3,600 may be contributed irrespective of earnings. The annual allowance is reduced by £1 for every £2 of income over 240,000 to a minimum of 4,000. And I saw from the budget information to 4,000 maximum if certain pension drawings are made. Stamp duty land tax. This is the extension of the residential stamp duty land tax nil rate band to 500,000 has now been extended until the 30th of June 2021. The next band, therefore, above that, up until that date, is the 5% band, which is to the balance up to 925,000. And then the balance above that, up to 1.5 million, is 10%. And the balance above 1.5 million is 12%. Second residential properties, there's a 3% surcharge. It's completely different where there are there's basically a surcharge of 3% for rental properties. But if you envelope a property in a trust and it's worth over 500,000, it's 15%. There's a new mortgage guarantee scheme. A new mortgage guarantee scheme. This enables all UK home buyers to secure a mortgage with a 5% deposit on their home with a value up to 600,000. It's to be introduced this April, and the scheme provides guarantees to lenders. Under the scheme, all buyers will have the opportunity to fix their initial mortgage rate for at least 5 years should they wish to. It's available for new mortgages up to the 31st of December 2022 on new or existing properties. There's been a change to the support for mortgage interest for claimants moving home. So this would include people that are on income support allowances, universal credit, or pension credit. It's to help claimants move home by allowing them to add the legal costs associated with transferring their claim to a new property to the value of their loan. And this can occur from the 15th of March 2021. It's currently paid as a loan, which must be repaid when you die, sell your home, or transfer ownership of the property. It used to be paid as a benefit, which you didn't have to repay, but that's no longer the case. To get support for mortgage interest, you must be out of work or of state pensionable age and get one of those allowances. This is helpful for individuals that have been brought up in care and those that have been in a homeless hostel. So it's to help, it's basically to help get them housed. The SAR, shared accommodation rate is usually, and this legislation is to relieve the difficulties this causes. So it's the maximum amount of rent that can be used in a person's housing benefit or universal credit calculation, where it's based on the cost of renting a room in a shared house or flat in their area, even if they live in a self-contained property. So they may have a studio flat or one-bedroom flat, but they would only be entitled to the equivalent cost of renting a room in a shared house or flat. So from June 2021, care leavers, so children that have been brought up in care, up to the age of 25, and those under 25 who have spent at least 3 months in a homeless hostel will be exempt from the SAR in universal credit and housing benefit, enabling them to access suitable housing. It was previously to be implemented in October 2023, but they've brought it forward to June 2021. Working tax credit and universal credit. The 6-month extension of the £20 per week for universal credit uplift has been announced, and there's also a one-off payment of £500 to eligible working tax credit claimants. HMRC are harmonising and reforming interest and penalty regime with a view to penalty for self-assessment. We're waiting for legislation in this regard. They've also introducing a green gilt and national savings investment, green investment. The adult ISA annual subscription limit for 21 to 22 will remain unchanged at 20,000. The junior ISA and child trust funds annual subscription will remain unchanged at 9,000. Green gilts are to be issued for green projects later this year, so we'll find out more about that later on, and something equivalent for national savings and investments. COVID-19 tests and home office expenses are going to extend the income tax exemption, so you don't pay income tax on those reimbursements, and national insurance contribution disregard for antigen tests provided by or reimbursed by employers, also for employer reimbursed expenses covering the cost of home office equipment to the 21-22 tax year. Contactless payment card. For single contactless payments, it's going to be increased to £100, and cumulative contactless payments up to £300 without the need to input chip and PIN. Transport taxes. Fuel duty has been frozen for the 11th year. Air passenger duty has been frozen for reduced and standard short haul, but then is to rise in accordance with the retail price index from April 2022. Long haul rates are to increase in line with the retail price index. Long haul economy flights from Great Britain will increase by £2, premium long haul by £5, long haul private jets, the increase will be by £13. Company vehicles, so car and van fuel benefit charges to increase in line with the consumer price index. Thank you for listening. Does anybody have any questions?
Yes, I do.
Hello, Steve.
Hello, I'm didn't quite catch the bit about trusts enveloping property and 15%.
Right. If a company or a trust is purchasing property over 500,000, so it's just one trust holding one property, then the stamp duty land tax would be 15%.
Right, thank you.
That's the value of the property over 500,000.
So if it's two trusts owning half each?
Then each one would be treated separately.
Excellent. Thank you.
Okay. And any other questions?
Are we waiting, Ingrid, for some more detail to be announced on the so-called tax day, the 23rd of March, to put some more detail behind what the government's thinking on future tax reforms? Do you think it'll be too early, or do you think that might come a bit later in the year?
I think it may come slightly later in the year. My concern is capital gains tax eventually going up to 40%.
Yes.
That's, I think, it will be our major concern at the moment. But I don't think it's going to happen imminently. But obviously, any announcements that come, I will hold another webinar and invite everybody again.
We might need it then.
Yes. Any other questions? Otherwise, we will stop recording.
Thank you very much, Ingrid.
My pleasure. All right.
Thank you very much.
Thank you. Bye-bye, everybody.
Thank you. Thank you again. Bye-bye.